look, guys, I got Marco Santarelli here. I brought him in. I mean, this is an awesome dude. Okay, we're going to talk today about houses. He owns 150 or 200 homes right now. So many of you watch my Monday show, and you're like, hey, I can't start with 300 units, Grant, like you had. We just looking at a $90 million deal.
Yeah, yeah.
And Grant, I can't start with 90 million. Okay, all right. So I bring Marco in. I'm like, Marco, can they start with some of your inventory and start creating passive income? We really appreciate you being here today.
Thanks, Grant.
He's in a space that I'm not in. And so many of you asked about how do I get started on my own. So a lot of you out there want to do it yourself. You want to swing the hammer, make the investment, get the loan. And so I brought Marco in to talk to you about how to start creating passive income. First of all, why is passive income so important?
Well, look, people want to they want to create financial freedom for themselves. Why? Because they want time freedom, right? But how do you get there? If you're trading time for dollars, you're capped. You can't scale that. You're always going to be working for earned income. But the key to creating wealth, the key to financial freedom, is your ability to convert earned income into passive and portfolio income. And the only way to do that, I mean, there's many ways to do that, and a lot of people think that stocks, bonds, mutual funds are the way to go about it. But the reality is, and you know this, very well, that real estate is the best asset class, the best vehicle to create that passive income, to create wealth, and you can do it relatively quickly.
Okay, tell me what he just said was, okay, like I love this Ask the Pro show. This is my favorite show. Convert earned income to passive income and portfolio income. Can you explain what the difference is between earned and passive and earned and portfolio?
Yeah. So with earned income, you have a W-2 income, as they say. You have your 9-to-5 job. You might be punching the clock, but if you don't show up, you're not making anything. You're not earning income. You have to be there. You have to show up. You're earning it. The problem with that is it relies on you. You're trading time for dollars, right. And there's only one of you, so you can't scale that. And third is, if you're in that category, you're taxed at the highest tax rate.
Right.
And so there's no way to build on that unless you're smart enough to take that and increase your income and take that and convert it into investments like real estate, where you can now create passive income.
And why did you say that? Well, go ahead and cover the portfolio then.
Yeah, so portfolio income is good, but it's not the best. It's really just income.
Well,
like
give me an example of portfolio income?
Buying dividend-paying stocks as an example.
Okay, AT&T.
Sure. So now you get dividend income. It's passive. It comes in. Granted, it's taxed at capital gains tax rates. It's okay.
19-20%.
Right. Yeah. So 20. Yeah.
But why do they call it portfolio?
Because you're building Well, it's kind of a name. It's labeled. Portfolio income because you're building a portfolio of alternative assets like stocks.
Okay.
Or ETFs or whatever it may be. But you're getting dividends off of it, so you don't have to show up for those dividends to come in. That's why it's
completely
still passive. But it's
you
not
could die and it's going to continue.
Correct.
But the downside is that the AT&T goes out of business and they can't pay it anymore.
Exactly.
And it's every quarter, not every month.
Probably. Right. Exactly. Or you may not even get it. There are many times where we didn't earn enough, and so we just can't pay the dividend.
Right.
But when you have passive income, whether it's in a syndication like an apartment complex, or you have your own portfolio of single families, duplexes, fourplexes, guess what? They used to call it, the checks in the mail. Now it's all, auto deposit. You don't have a check in the mail anymore.
I miss checks. Do you miss checks?
I kind of miss checks because I like signing and depositing. It's tangible.
I like sending checks to people because we do I don't know, about 1,100 direct wires a month.
That's a lot.
Every month we send out to our investors, and nobody ever calls me and says, "Oh my God, thanks for the wire."
Yeah.
But you send them a check, they're like, "Hey, thanks for the check."
Yeah, exactly.
Because they see it.
Exactly. So checks in the mail, and that's passive income. So when you have rental property, whether it's, syndications and or a portfolio of your own real estate, you get that check or that deposit every month, and you don't have to go to work for that. Now, what if you built up a portfolio big enough where you have enough units, enough rental properties, that passive income that comes in is more than your cost to survive, like your living expenses.
More than your earned income.
More than that, like to maintain your lifestyle, because you could be borrowing to maintain a particular lifestyle.
Yeah, but I wouldn't think. This is just good for discussion, but I would not. My goal would not be to have passive income to pay my bills. It would be. I'm just greedy, right? Yeah. So I'm like, who did I hear say this before? It was a comedian. And he says, look, I never spend one. It was the late night host.
Johnny Carson?
No, the guy.
Jay Leno?
Right after him. No, it wasn't maybe it was Jay Leno. He never spent his second income.
Right.
He never spent any of the money from the the Tonight Show. He did his acts on the weekends to pay his bills. So I would just say my earned income would pay my bills. My passive income.
Mm-hmm. That might be another way to say pay yourself first.
Yeah, right.
The thing is if you make $2,000 a month or $5,000 a month, whatever it is, if you 5x, I know you like 10x, and you can just turn this into a 10x. If you can 5x your current active income, you can support the lifestyle that you probably always have dreamed of. So your initial goal should be 5x or 10x your income, your income to live and maintain your lifestyle. If you can 5x that, you're truly financially free.
So if a guy's making $5,000 a month and living on it right now, if he's making $5,000, most of the country is.
Yes.
You're saying the goal would be what?
If you could hit that 25,000 passive income
from passive.
Yes, passive income.
Wow, dude, you're more aggressive than I am.
I love to be aggressive. I have big goals, just like you. The thing is if you can achieve that, and you set as a target, look, even if you don't hit it and you come close, you're still doing great.
Right.
But now you truly have time freedom. It's not just financial freedom. You have total time freedom. You do anything you want, anytime you want. You're on your own terms. You run your life.
See, I would think, to me in the beginning, I would think, like, if I could just 1x, like, if I could just let's say I'm making $4 or $5,000 a month. My first goal was, like, if I could just make $4 or $5,000 passive to match that, live off the first 4 or 5, and start rolling that second one. But I like the way
Can I tell you why that doesn't work?
Tell me. It kind of worked for me, but
it is easier to achieve 5x or 10x your income than it is to 2x.
I agree with that.
You know why? It's because most people think that in order to double their income, they have to work twice as hard.
Right.
They have to get a second job or double their hours or get overtime or whatever the case is. They're still in the mindset of earned income and putting in time for money.
It's the only thing we've been taught is to earn income.
Well, you don't get that in school. There's no financial education. This is why it's my mission through my podcast and all the things that I do to just push tons of content. Like I'm going to be with Robert Kiyosaki this weekend and Peter Schiff and a whole bunch of guys that are just amazing people, and we just feed off each other.
Yeah.
But here's why 10x and 5x is easier. Because you can't work 5 or 10 times as hard.
That's right.
You have to now start thinking in terms of systems and other vehicles or strategies and plans that get you to 5x or 10x. And that means you have to do it with a team. You have to do it with other people. You have to build that portfolio. You have a team of property managers or invest in apartment syndications.
Whoa. Don't go there, dude. My audience is thinking about buying their first house, man. You're talking about systems and management teams, and I'm not going to start there. My first deal did not involve people and systems and processes.
Right.
Because I think, the real estate itself is a bit of a system, right? Like you made a comment, real estate is the best for creating passive income. Why do you say that?
Well, because it is. Because it's a hard asset. It's a great inflation hedge. You have cash flow, and your shirt says cash flow is king, and I totally agree with that. I say that all the time.
Yeah.
You have cash flow, you have appreciation, you have amortization of the loan, and you're not paying that loan.
Amortization what?
Amortization of the loan.
Of the loan, meaning?
Meaning your tenants are paying the mortgage off for you.
Right.
Right?
That's good debt or bad debt?
That's great debt. It's the only way to truly magnify and accelerate your wealth creation. There's no other way.
So, just so you guys understand.
Unless you go IPO with a publicly traded company. There's no other way to just have that.
Yeah, so just to simplify Louisiana this, my grandpa, we're driving down the road, and I'm like, I'm hungry, Grandpa, so we pulled over. We're in the ditch, man. He's like, get some crawfish. There's crawfish down there. We'll bring them home and boil them. So what he's saying is, back to the 5X piece. For those of you who are saying, hey, I'm earning $4 or $5,000 a month, how do I buy a couple of houses, 3 or 4 houses, and match the 4 or 5? Because if you put debt on those, okay, and they appreciate, and the debt is now paid off by the renter, the 5X will come from appreciation and not paying the debt down, because it's going to build wealth through that multiplier you're talking about. You just want to talk a little bit about how the debt gets paid down and what happens.
Yeah, well, there's 2 points I'll make to that, because that's a great comment, a great question. So, over time, that mortgage is paid off by your tenants. So it's called amortization of loan. So that means the equity is growing in the property, which means your net worth is growing. Over time, if you buy the right markets and the right neighborhoods,
Yeah, yeah.
that happens 99% of the time.
No, come on, man. Not 99, dude. Not 99 in
Okay, I'll
Detroit.
buy 9.
In Detroit?
I just said good markets and good neighborhoods.
Okay.
That is a major qualifier.
Okay.
And by the way, you're opening up a can of worms here, because a lot of investors make the mistake of saying, "Hey, here's a cool deal," or "You're presented. Hey, this is a great deal. It's been renovated. It's beautiful.
Yeah,
Look at the
yeah,
pictures.
yeah.
The numbers make great sense. In fact, the cash-on-cash return is so high that it's almost a little bit unbelievable. But the numbers look great.
Right.
And I've made this mistake. That's why I can speak from personal experience. But oh, by the way, it's on a sketchy street. There's some burnouts. It's in a very rough neighborhood. It's in the middle of a war zone, and it happens to be in the middle of Detroit. Not to pick on the city of Detroit, but I have personal experience there, so I can speak for it.
Every city in America, by the way, has a dying market.
Correct.
In the city. So you could go to Austin. I promise you, in Austin, as much as Austin is talked about every day, you can still find parts and pieces of Austin that are going to die and decay.
Yeah, absolutely. Every city's like that. So we call it a top-down approach. It's actually one of my 10 rules for successful real estate investing. My 6th rule is take a top-down approach, which means you don't start with the property, which is the mistake a lot of investors make. They're looking at this property and they're doing all their underwriting or due diligence on the one property, and they say, yeah, that's a good deal. But they forget that they need to consider the neighborhood, the sub-market, and the market as a whole, because those all play into the long-term future of that property. So when I say properties almost always appreciate over time, I'm making the assumption that you've bought right.
Right.
Good market, good neighborhood, right team. So if you have that, you have appreciation over time. It's going to happen because there's just constant demand in this country, in virtually every market, for real estate, both rental and purchase. Second, we have the effects of inflation. It's going to constantly push up the price, not value, the price of commodities: sticks, bricks, concrete, copper, all the stuff that goes into it.
Sticks, bricks, concrete, copper.
Correct.
Are going to go up. They're going to cost more to produce.
They have to, because we're in an inflationary environment. We have been for decades, and we will continue to do so.
Yeah.
Okay. This economy with
So you're saying the cost of putting a new house there is going to be prohibitive in the future. It's just easier to fix the one that's there and get rent out of it.
Not necessarily. It's just the cost of building materials just continues to go up, right? So it's unlikely that property values will come down because materials are going down. That's not likely to happen. So the appreciation can come through value add, forced appreciation. It comes over time through sales going up. But your equity, we kind of went off the rails.
No. I think you're right on the rails.
So, the equity grows because the loan's being amortized, the property value goes up in time. But the beautiful thing about inflation is if you have this good debt, which I call great debt, on the property, the effects of inflation over time on that debt erodes it away. If you get a 30-year fixed rate mortgage on a property, the monthly payment doesn't change every year. The bank doesn't readjust based on inflation.
Right.
So if it's a $500 per month mortgage, just to pick a number out of the air,
it's never going to.
In 10 years from now, it's still $500. But in 10 years from now, that $1,000 per month in rent might have gone up to $1,200, $1,300, maybe more.
Right.
Right. So this is fixed, but everything else increases, and this is why your income increases, your equity increases, your wealth increases.
Yeah, and even if those other things didn't increase, this still stays fixed, and the debt's going to go to zero at some point.
Yeah, that's the
So
worst case scenario.
Even if you didn't get inflation, because we don't know, maybe we go through a deflationary stage, right?
You could.
At least you have an asset, something you can touch and feel that is now paid for by someone else.
Right. Yeah, absolutely.
Now let me just ask you, because I think a lot of people don't understand, when you buy a house, and then I want to talk about your 150 to 200 homes that you have. When somebody buys a house today, I think I know the right answer to this, but when I go out and buy a home today, how much of that interest can I write off when I take a loan on a $700,000 house?
Well, interest is deductible. It's a bit.
Up to what point?
With investment property, 100%.
Okay, but on a place where I live.
Well, that's your principal residence.
Yeah.
I mean,
you can write up to 750. Up to 750, they just extended it. So I think it went from 450 or 475 to 750. So that's about $60,000 a year. No, $40,000 a year in interest. But when I buy an investment house, just explain to the audience, 100% of what?
100% of all expenses.
Listen, folks.
Yeah, 100% of all expenses are completely deductible because it's a business expense. When you have rental income, you got to think of it as a business. It's the business of real estate. You are making investments, so everything is a deduction.
So if I have 10 homes, with each of them have just $200,000 worth of debt. I have 50 homes with $200,000 worth of debt. That's $1 million worth of debt, but $10 million. The interest paid on the $10 million is 100% tax deductible.
Correct. Yes.
Dude, that makes me so happy.
I love it.
Now, keep in mind, if you own one house and you live in that one house and it's not a rental property, you can only deduct $40,000 a year. Like, you guys got to start paying attention to what he's telling you right now to leverage into assets that can start producing wealth. Because he's shown you 3 ways now to produce wealth: cash flow, the appreciation that comes from the gap that comes from the pay down, and the third is your tax write-off.
I'm just going to throw out a really oversimplistic example, but it's reality. Let's take a hypothetical example that is doable for most people.
Good.
Okay? If the properties that our clients purchase through us range from broad strokes here, $80,000 to $180,000 for a single-family home.
Okay.
You know, duplexes, fourplexes are a little bit different.
You found it.
We have them all the time. We have anywhere from 100 to 200 any given day available for purchase right now. But we don't just let you buy a property today. We need to understand you, your investment goals, where you are, where you want to get to, what's your risk tolerance. Let's map it out as a plan. If this is your income goal, how are we going to achieve that? We work it backwards. We need to understand you. It needs to start up here. It's not just about the properties. It's about the team.
I want to make money, man.
It's about everything. But it starts with understanding where you want to get to.
Okay.
But I'm just talking about real estate, the real estate part of it only. This is a hypothetical example. The reason I give you the range of $80,000 to $180,000 is because the median price of what we sell, what our clients purchase, is $120,000 for a single-family home. So call it $120 per door.
Okay.
Now let's just call it $100,000. Let's just say over the next 5 years you bought one per year. You have 5 of these $100,000 homes. When the day comes,
They're paying cash for this, or they're putting debt on it?
they're always financing it.
Okay.
20% down.
You help them. You help them. With
We
the
have everything they need, everything, from soup to nuts. It's basically the lending is there. It's all investor financing. So let's just say you put 20% down, times 5. That's $100,000. Over
Okay.
the course of 5 years, you have 5 houses. These are 5 $100,000 homes today.
Right.
In 10, 20 years, those may be $150,000. You know, I'm not going to speculate. I don't speculate.
Yeah.
But they'll be worth more.
Could be worth a little less.
Could be worth a little less. But that's why cash flow is king, because
Right,
they
right.
need to make sense the day you buy them.
Right.
They have to produce income from day
I
one.
love that, dude.
So that's the partial definition of our inventory. You know, we can define what it is. But going back to the example, let's just say in time, call it 5, 10, 20 years, whatever it is, those are completely paid off. You decided not to purchase more than 5. Now you have only 5 properties. I say only in quotes. If you have 5 properties and those rent for $1,000 a month,
Is that real? Is that a real number?
absolutely.
Uh-huh.
It's called we call it the rent to value ratio. Some people refer to it as the 1% rule. Essentially, what we're trying to do is achieve about 1% of the acquisition price on day one as your rent. So a $100,000 home rents for $1,000 a month. So today, if you had all 5 properties, you'd have 5 $100,000 properties renting for $1,000 a month. Now, it's not $1,000 going into your pocket today because you've got to pay for property management, insurance, taxes, and your debt service. But what's left over is your positive cash flow, and that goes straight to your pocket. I suggest you reinvest it, by the way. So just as FYI.
Yeah.
But the day will come where you have these 5 properties free and clear, and it's no longer 1,000 times 5. It's now maybe 1,500 times 5, 2,000 times 5. Guess what? That's 1,500. That's $5,000 to $10,000 a month passive income that you're living off
Because it's
of.
paid for now.
Yes, it's paid for.
And it won't be completely all yours because there'll still be management and electricity and lawn care and some.
Yeah, there's going to be some nominal expenses, but just oversimplifying, the
Yeah,
gross
yeah.
rental income is going to be between $5,000 and $10,000. So,
In the years where you're going to really need it too. If it's
yeah,
15, 20, 30 years down the road.
right. Yeah, you can use it at any time. Just reinvest it. Keep building and building and building and stacking on top of what you've done. But if you only wanted 5, the day will come where you have 5 free and clear properties paying you upwards of $10,000 per month. And can you live off that? Most people can. It depends what your lifestyle is.
Right.
I have expensive taste, but
Yeah.
I'll need more than that. But
All you got to do is get more houses.
but that's a simple
And it's-
example.
Yeah.
5 houses is doable. One
So
per
what's
year.
the downside of somebody starting with one house? Let's just talk about what's going to keep somebody from doing this. Guy's watching right now. He's got a job. He's a mechanic, cutting hair. What prevents somebody from doing this? Like you've collected the assets. They're all over the country, or
We're in 22 markets that make sense.
Yeah.
Obviously coastal markets like where I live in Southern California, Doesn't make sense,
Mhm.
right?
Because it doesn't make sense because of what?
It's very expensive. You know, to get a single family home that's $6, $7, $8, $900,000, it won't rent for enough to cover everything and produce an appropriate cap rate or cash on cash return. Or there's a lot more downside risk. It's a more volatile market. It's what I call a cyclical market. It just doesn't make sense. You know, you've got an unfriendly landlord environment there.
Very
Yeah, the laws aren't stacked in your favor as a landlord.
Right.
You want to provide safe, clean, functional housing to people in good markets and
not be mistreated.
Exactly.
Yeah.
Right. So there's a lot of markets where the numbers don't make sense. I've actually trademarked the saying, live where you want, invest where it makes sense. Because I firmly
Invest where it makes money.
Where it makes sense. Yeah.
Not
well,
sense.
Well, the other sense.
Oh, the other
SCN.
sense. Okay, see, that's just a different word.
Right.
Okay,
Good
so how many houses do you recommend somebody starts with? You're like, well, I got to have a meeting with them. Okay, have a meeting with them. Okay, so I make $5,000 a month. I'm a mechanic. I run a salon, and I make $5,000 a month. And I'm a single mother, and I have a kid. And he's gone.
My simple answer.
And I got $100,000 sitting around.
My simple answer to that
Yeah.
is start as soon as you can because you want time on your side, and invest in as many as you can, as fast as you can. Build up enough savings as fast as you can where you can deploy it into your first and your second and your third property. And if that's hard for you to do, maybe for a short period of time you need to get a second job or work more hours or increase your income or start a small business where you actually get tax benefits and increased income from that small business, which is a very smart thing to do. But you want to increase your income so you can save as much as you can, as fast as you can, and redeploy it quickly and as often as possible because you want to build a portfolio very quickly, as quickly as you possibly can. That for some people it's 5 a year, for some people it's 1 a year.
Right.
But think about this.
But get started somehow.
And you don't need a lot. Like a $100,000 home is $20,000 down plus closing costs and a few thousand in reserve.
That's a commercial. Is that a commercial loan or is that a?
It's conventional financing.
How many of those can I do? Before they stop?
10 per credit score. If you're married, theoretically you can do 10 each if you both qualify, so 20 per family. But then we have lenders that are portfolio lenders where you can purchase investment properties almost on an infinite basis. Like if they don't actually have a cap because they're qualifying the property, not just you.
Right.
It's really more about the property than you.
Yeah, you just hear what he just said. Okay, the bank is lending not just to you, like they do on your house.
Yeah.
They're lending on the property's ability to produce income in the future.
Correct.
And the bank becomes your friend here. Banks are much friendlier when you're borrowing money to invest in properties that produce income. Much friendlier, they're allies than in the relationship where Johnny goes out and buys a house.
Ally is a great word. I consider the bank your friend.
Yeah.
Your investment partner because
Totally.
they're investing in 80% of that property.
Right.
They're on the hook for 80%, right? You're on the hook for 20%.
Yeah.
So they want to make sure that the deal is a good deal and makes sense.
What kind of returns can somebody expect? Cash on cash returns.
Okay, I was just going to say, how do you qualify that? 'Cause-
Cash on cash,
Yeah.
and then we'll look into the future.
So there's three numbers that you could look at when it comes to investment property. There's cap rate, which to me is very simplistic. It's very one-dimensional. It's oversimplistic. I don't like just looking at cap rates. But for those people listening to this and they're thinking, oh, what's a cap rate? Cap rates are going to range, broadly speaking, from 6 to 9, maybe 10%, and that's really going to be market specific and neighborhood specific.
So explain the higher what happens. The higher they go, the more you know about what. If I don't see the property, don't know anything. You just hear a 9. What do you think? What's the first thing you hear when you hear a 9 cap?
Well, when I hear a 9 cap, the first question I ask is, are they deducting vacancy? Are they budgeting for vacancy allowance? Because it's not going to be occupied 100% of the time. Are they deducting for vacancy, and are they deducting for maintenance and repairs?
Well, no. Let's say these are actuals. Let's say the caps on actuals. Okay. And the 6 or the 9, they're both calculated the same way.
Okay.
You hear, hey, dude, I got a 9 cap. What's the first image you get?
C neighborhood.
Yeah. Okay.
Right.
It's a 6 cap, man. What do you say?
Probably an A- neighborhood.
Which one are you most interested in when I say that to you?
Me personally?
6 or 9?
Well, I'm interested in the 9, but there's a big depends right after that.
Right.
Because I don't speculate. I want a good deal, but again, for me, it's market first.
Right.
Neighborhood second. Property third. Meaning no deferred maintenance or new construction. We have both.
Yeah.
And then the team that surrounds that. That's critically important. I say you live and die by your property manager. I want the best management.
God, see that's when you start making the argument for what I'm doing.
Well, yeah.
I mean, you just stepped in.
I get it. I'm in your space too.
Yeah.
You know, I love
So
syndications. I get it.
so let's say I have a long-term vision. Let's say the person's watching right now and they're like, you know what? I'm not carrying a Glock with me everywhere I go. I don't want to go collect rents. I don't want to freaking jam on doors. I don't want problems. And they have they're willing to accept a little less cash flow.
Mm-hmm.
Should they be looking at the 6 long-term for the long-term
Yes.
appreciation, or they're not?
No, I absolutely. For a lot of people, that is true because
Yeah.
I'll give you an example. There are a lot of people call us up and talk to one of our investment counselors, and they say, "Hey, I want to get started, or I want to start small, or I want to dip my toes in the water because it's my first rental, or maybe my second. I had a bad experience with the first." To them, in their mind, they're thinking, "Well, that means a $60,000, $70,000, $80,000 property," and I'm saying, "No. You don't want to be in that type of neighborhood, in that demographic, or that tenant class. I mean, it is what it is. Call it what you want.
Yeah, have a good experience first.
Absolutely. I'd rather they go into an A- neighborhood,
Totally.
quality schools, low crime, the whole quality experience, so they're happy.
It's so contrarian to what people do.
Absolutely.
Because people are like, oh, I'm just going to go buy something cheap. Cheap is the wrong thing to do.
You're right.
Right? Talk about that.
Well, yeah. I mean, I've had my own personal experience there, but a lot of people buy in these low-end, low-income areas, and I'm not saying it's good or bad. It is.
No, but
what
they never
is.
do it again because their experience is so negative.
Right. Look, I'm not going to mention names. There are people out there.
Mention names, man. Go ahead.
No, I'm not going to.
Come on, give me a name. Give me a name.
There are people
A
out
person?
there,
A person's name?
companies and people,
Okay.
out there that are hawking, selling these.
Yeah, give me a letter.
40,
Give me a letter.
No,
Give me initials.
I don't need
Give
to
me
go
an
down that
initial.
road. I'm too good for that.
Okay.
Seriously, but look,
Who is it? I want to know who it is.
40. I'll tell you offline.
Okay.
$40,000, $50,000, $60,000 properties. They buy these thinking that I got a good deal because it was cheap and the
Yeah.
cash flow, like the rent to value ratio, is like
Yeah.
1.2%. It's like,
Right.
damn, that's great. But look, at the end of the day, they're going to have more transient tenants. They're going to have more vacancy time, which is costly because they're not getting income, and the turnover is the most expensive thing in holding any kind of unit or rental. So anything you make during the course of the year is going to be wiped out by one turn.
Yeah. And the appreciation is not going to be there in the future.
Exactly. That was my second point. Is
Yeah.
that $50,000 home was probably a $50,000 home 10 years ago, and probably will still be a $50,000 home 10 years from now, unless you have gentrification in that neighborhood.
So what's that word?
Gentrification.
Oh, wow.
There you go.
Gentrification. What does that mean?
That's the big word for the day.
Yeah.
Sesame Street.
What does that mean?
Gentrification is just an area within a city that's undergoing complete revitalization. So it's an up and coming area. Usually it's a dilapidated
Oh, that's
area.
a good thing?
It is a good thing
Okay.
because
So downtown Detroit's is happening.
that would be an example of gentrification.
Gentrification.
There you go. That's
Yeah.
a big word.
Let's see if they can even hold on to their gentrification.
We'll see. Time will tell.
Yeah, I know downtown Las Vegas, the guy that did Zappos, he went in there and threw a bunch of money into downtown Las Vegas and just started buying everything.
Mhm.
And then he looked up one day, by the way, all billionaires are not brilliant, okay?
No.
So you got to have other buyers in the market. You can't be the only buyer in a market and think you're going to pull a market up. You'll pull it up for a second
Yeah.
until you realize there's nobody following me into this market.
Yeah.
So what are some good markets where there's other people going in, other money going in, people are interested? What's your top 5 list right now?
So we're in 22 markets for different reasons. We kind of classify markets into 3 categories. There's growth markets, which have strong appreciation potential, and there's drivers for that. And then on the other end of the spectrum, we have what we refer to as cash flow markets. They're great for cash flow. They're just boring markets.
Yes.
Stable, sleep well at night.
Give me examples.
Memphis,
Okay.
Tennessee.
Oh, wow.
Yeah.
Wow.
Now, of course, you can get more granular on this. It's not
No,
just.
give me the first 5. Give me the first group, the growth markets that have potential. in the
So I'll
future.
give you a few of each, and then we
Yeah,
the
please.
middle of that spectrum is what we'll refer to as a hybrid market. It's kind of
A little above.
It's in the middle of the spectrum. So a growth market would be like Jacksonville, Florida,
Okay.
Tampa,
Okay.
Florida,
Yeah. Give me another.
Houston, Texas.
Okay.
Okay.
Keep going. Give me two or three more.
Okay.
A lot of people watching, man.
Well, let's go to cash flow. Cash flow. Memphis, Tennessee.
Uh-huh.
To some degree, Oklahoma City.
Okay.
Indianapolis. Now, Indianapolis is kind of bridging to the hybrid type market. Kansas City, Missouri, is a hybrid market.
Right.
Dallas is definitely a growth market, but it used to be a cash flow market.
Yeah.
It didn't have any appreciation. Then all of a sudden, in like 2011, 2012, it started to just kind of turn. A lot of people moving
People
in,
leaving
a lot of jobs.
California.
Absolutely. It's been
Yeah.
going on for 15, 20 years.
So, by the way, if you just look at the cities he just mentioned, okay, like if you go Jacksonville, Tampa, I think Orlando you'd include in that. What did you say? Houston, Dallas,
Indianapolis, Kansas City.
okay, if you just look at those cities, like go Google those cities, you're going to see similarities, like feelings. I mean, you can just feel something. Then the other cities, the Memphis, the Oklahoma, Cleveland, you'd probably not.
Well, Cincinnati and Cleveland are more cash flow plays.
Yeah, right.
Yeah, cash flow markets.
You're going to have a tone or a sense, a feeling of those that push to cash flow. So increased cash flow, maybe not as much growth, right?
Right. And you know what
Where would
drives
you
all
rather be?
this?
Where would you rather be with your money today? Going forward, if you got a 10-year horizon, where would you rather be?
Well, if I'm just starting out, I would do what I said. They stick to hybrid or growth markets in good neighborhoods, just because I know that I want time on my side and I want that equity growth in the beginning, because I'm going to redeploy that equity to accelerating and leveraging up my portfolio and build it up bigger and faster.
You're getting heavy for them right now. This is where the wealth creation. But you're not going to know this until you start the game. But now he's talking about how to refi properties, go back in and put them together, sell them, capitalize them, right?
Yeah, exactly. And so, yes, this is a more advanced strategy. Like the thing is
this is where you get rich, though. The advantage.
That is how you get rich.
That's how you get super rich.
So investors have call it a journey. They start off with nothing, no property, and they get to a point where they're talking about legacy wealth and passing that on,
right,
and more advanced strategies.
Yeah, yeah.
Well, that journey, it's a 9-step journey. We cover that whole life cycle.
Do you have a program for this, then?
Yeah, it's a financial freedom formula. It's
okay. Where do I get it?
Just go to our websites.
Okay, the website is.
There's 2 of them.
PassiveRealEstateInvesting.com. Nothing to buy, by the way.
No,
shame on you.
I know.
Shame on you.
The master
Dude,
sales here.
I told Steve Harvey the same thing. Steve got on my stage and he said, "Man, I don't have anything to sell these people." I'm like, "Shame on you, dude."
I'm working on it though.
So we need to get people something they can buy, because people, your attention follows your money.
Yes, absolutely.
So where you don't pay anything, you don't pay attention.
Correct.
PassiveRealEstateInvesting.com is the podcast. I'm going to come on your podcast, by the way, and love what you're doing. And what's the other website?
So our company's Norada Real Estate Investments. So NoradaRealEstate.com, but some people don't have a hard time remembering that.
Yeah,
so
we'll put the link below. Maybe you guys change the name.
Well, I have a lot of domains. TurnkeyRealEstateInvestments.com.
TurnkeyRealEstateInvestments.
Takes you right there.
Dude, why don't we just use TurnkeyRealEstateInvestments.com?
Well, then,
I like that
you just
better
did.
than Norada.
You just
and
did.
what you can do is you can just, what can he do? He can just turnkey real estate investing, and yeah, that's the one to use.
There you go.
Because nobody's going to forget that. Turnkey, I want the turnkey.
It's true.
Okay, Marco Santarelli, how many houses does a person need? I mean, just tell them the real deal, dude. To get financial freedom, what's the target? The first brief little look at, okay, I got enough money coming in now.
Every question you asked me today could be its own show or podcast episode, literally.
Yeah, I know that.
It could be.
Yeah.
The quick and dirty.
Questions, right? Is that what you're saying?
Well, you could take every question and make 30 minutes out of it.
Yeah, totally.
The quick and dirty answer to your question
Yeah.
is if you're looking for financial independence, 5 houses for most people will get you to financial independence. Independence, not freedom.
Yeah, but it's only a couple $100 a month.
Initially, initially, no, that's not enough initially. But,
Okay,
but I'm just saying, if you just wanted to buy 5, sit back and continue doing what you do, and you're happy with what you have, qualifier, that'll get you there in time. But that's not enough for most people.
This is not my
That's not a big enough.
My audience is they're freaks.
I agree.
So how many houses? What's the target somebody should have for how many single family residents?
25 to 50 is what you should shoot for.
There you go.
25 to 50 is what you should shoot for.
So if you bought 5 a year, 10 years, Johnny, how old are you, Johnny?
28.
38 years old, he'd have 50 houses.
Yeah, I think real loose numbers. Budget $300 per month, net passive income per house. per door, whether it's a duplex, or fourplex, or a single family home. Shoot for that number. Fully leveraged, meaning you're only putting 20% down. You're leveraging the rest. 250 to 300 total triple net is what you should be doing for rough numbers.
That'd be 15 grand a month for Johnny.
That you could live off that.
Net. Okay. Now, and Johnny would still be shooting photographs of me on the weekend. Okay. So now the big question, and we'll close out. All right. Okay.
Sounds good.
Why what you're doing versus what I'm doing?
I knew he was going to ask me.
I gotta go there, dude, because everybody's like, okay, what should I do? Should I do the houses? Or should I do the multifamily?
Okay, there's probably 16 reasons.
This is another show too, by the way. We could do this. We'll take this up on the podcast.
I'll fly back to
Yeah.
Miami.
Yeah.
Look, I'll do
Okay.
another episode.
Good.
Look, just let me give you a couple real quick. First of all, there's a lot of people. There's more people out there who are not accredited investors, and I know you got the Reg A, and I know your attorney. I know your attorney. She's beautiful.
Yeah.
Most people are not accredited, so they can't participate in most syndicated deals.
That's right. The deals I'm doing, they can't.
Right. Yeah. We're doing a development in Palm Springs right now, and you have to be accredited, right? It's a
Right.
$6 million raise, not a big one, but it's a good deal. I mean,
Yeah.
it's 20% internal rate of return. It's a steal of a deal. But most people don't qualify. So, and another thing too, and we have these conversations often. A lot of people don't get it or don't really appreciate big real estate, like large deals, like apartments. They didn't grow up in an apartment.
Well, why don't they appreciate it?
Good question. I don't know. It just doesn't resonate with them. They grew up in a
I
house.
don't know
They
if
feel,
this is true what you're saying, but
I don't know if it's true. It's anecdotally.
It's you. It's you. This is
my feel
your
from
vibe.
conversations.
Yeah.
Yeah. I can't quantify this,
Yeah.
but I'm just
I
saying.
appreciate the honesty, by the way. You know.
You got to be real, man.
Yeah.
This is just what it is. You can't BS people.
Yeah.
The thing is that a lot of people understand and appreciate houses. They get it. It's the most basic, fundamental housing unit, and so people get it. Besides, if you look at the housing stock in the U.S., the bulk of it is single-family homes. Another point I'll quickly make is that
That's going to change, by the way.
well, we could change it together. Change the world.
It is going to change.
So you're right.
Changing it.
No, yeah,
The bulk of
you're
new
right,
home
the trans-
housing that's being built today.
Absolutely.
Like when you hear the housing numbers today, the bulk of that housing is not what people live in. It is.
It's
they're
changing,
building
yeah,
apartments.
because housing has become unaffordable, and you have to come down and build affordable housing, and often it means just stacking people up on top of each other.
Yeah.
Another subject.
Yeah.
But another quick point I'll make to answer your question is that as illiquid as single family, or as illiquid as real estate is in terms of an asset class, single family homes are by far the most liquid form of real estate, because you're not just selling to investors.
Dude.
We could debate that.
Dude.
We could debate that.
No.
Really? Okay, I'm open to it.
Because
Respect.
look, if I'm buying a deal right now, okay?
Okay.
It's right here in Florida. It's two deals actually, 720 units.
Okay.
It's going to sell for $190 million.
Okay.
There will be 10 guys trying to buy that deal.
But you just answered your own
It
question.
will sell. It will sell for sure, without a doubt. My portfolio, I could dump my whole portfolio faster than I could dump my condo.
If you price it right. It all comes down to
That
the
condo
return.
that I have right now, I would have to go to the floor to sell that thing right now because there's so much condo product. There will always be a buyer because the Blackstones of the world, the guys that would buy my portfolio, they always have money. They're never broke.
We would hope.
Okay?
Yeah.
Well,
Unless we
if
have
they're broke, dude, America is finished.
true. Yeah. If we have another great recession, that may be a problem.
The problem with Johnny selling those 50 houses, he's got to go find 50 buyers that have money that want to live in a house today and or another investor at the low end. Okay? That's my only pushback.
So I understand your point. I guess the point I'm trying to make, and we're talking about.
And I only said this because you said the house, the single family house, is more liquid than my apartment building.
And here's what I mean by that. I'm looking at it from the perspective of the size of the buying pool. With a single-family home, you have a very large potential buying pool because you've got all the homeowners and the pool of real estate investors that will buy it if the numbers make sense. So you've got, call it thousands of people. Whereas your deal that you just mentioned, literally said 10 people.
10 people, but they got more money than the other 1,000, than 10,000, than
Yeah,
100,000.
doesn't necessarily make it more liquid. It might make it more interesting
Nah, it makes
from
it
a
more
sale
liquid.
perspective.
It makes it more liquid. For
So-
sure more liquid.
Right. Well,
They always have money, bro.
true. They always have money, but it doesn't necessarily mean they want to buy or will buy.
Look, when 2007 happened, okay, Blackstone came in, one example. They bought 10,000 condos in this town.
But take the
When
Blackstone-
nobody was buying.
Okay, take
But
those
that's what I'm
guys-
selling to.
That's you. But if you take those guys out of the equation, we're talking about average Joe average investor. Most people.
No, I just asked you. No, I didn't even ask you. You said
Okay.
your house is more liquid
Yes.
than my apartment deal.
I
Just
said in
remember,
general,
when the world
single-family
went to hell,
homes-
when the world went to hell,
Uh-huh.
nobody was buying.
They weren't buying either.
No, they were renting them though, which speaks
True.
well to your argument about Johnny keeping those 20
Yes,
out there.
yes.
They're renting them, and that's what you guys are doing. You're buying houses to own,
Yeah.
to rent to others. So don't get confused in our conversation here, because you're renting. And the point of this today, the reason I brought him here is because this is a rental game. This is a cash flow game. It's not about how much that property's worth to you today. It's about, I got cash flow.
Yeah.
And it don't really matter what the damn thing's worth. I can make an argument for buying a house that goes to zero over 30 years. Like I can get $1 for it when I sell it, and I'll bet you it'd still return me 15, 20, or 25% over the life of the time that you own it, and no other instrument does that. While you were getting tax advantages, you had the leverage, you created passive income that you can't do from a job.
Yeah.
So you and I would go back and forth and come to the same place right now,
Yeah,
which is
the
start
roads
buying real estate.
The roads lead to the same place.
Yeah, yeah.
You want to create cash flow for that passive income
Right.
and create wealth through equity growth over time. I mean,
Yeah.
the end result's the same. The path to get there is just slightly different,
Yeah,
even though
that's
it's in the same world, the
Same-
same
same
asset
world.
class of real estate.
Who's the dude that you were mentioning earlier? Who's the guy?
I ain't saying
Give me
that.
initials, dude.
You're really pushing, man.
That's all right. I'm just kidding with you. So,
right.
okay, what's the biggest mistake you made in real estate before we check out?
It's going to sound so obvious. Look, I bought my first property when I turned 18. Why? Because I could qualify for financing. But that's when I jumped in the game, and I've been doing it ever since. The biggest mistake I would make, and most people wouldn't think this being a mistake, but it's hindsight, is I kept that property for years, and the equity grew, and then I sold it. And I didn't reinvest that money.
Mm-hmm.
I should have. I didn't know any better at the
Right,
time.
right.
You know, it was like ignorance, college. You know,
Score, huh?
yeah, I mean, I made off great.
Yeah.
But I should have never sold that property. I could have done a
Right.
tax deferred exchange
Right.
and done better things with it. But the lesson learned was never sell your real estate. You can trade up and exchange it and do better and greater things with it, but never sell your real estate. You'll always have a portfolio. Just move the equity and do better things with it. But just don't buy, take the appreciation and run. That's dumb.
TurnkeyProperties.com, okay? Mark, right? Turnkey?
No. Turnkey real estate investments.
Turnkey Real Estate, edit that out. Turnkey Real Estate.
TurnkeyRealEstateInvestments.com.
Investments.com, man. It's a really long website. And the podcast, you'll have me on. I'll promote it for you. We'll get it all over the place.
Hey, that'd
Okay.
be cool.
Appreciate you coming in today.
Great, thank you.
Hey, bottom line, guys, look, you need to know the game. You tuned in today because you're interested in real estate. You're interested in cash flow. You're interested in passive income. You're interested. And congratulations. Now what you got to do is tap in, find out where to get started, do your research, do your homework. A lot of great takeaways today. Okay, 6 is probably better than a 9.
Depends. It's the short answer.
Yeah, but it's a short answer. But if
It's a good place to start.
It's a great place to start.
Great place to start.
Start with a winner.
Start with quality.
Start with quality. Okay. Thanks for watching today.